0% because he went over the 12 months, which is annoying. But it just is what it is, cost of doing business. And
like I said, they're a bigger lender, so they're going to have certain just processes in place. And when you do this, that happens. When you do this, that happens.
It's very much like bots ticking exercise. But that is it. And today we have another episode of the Property by Kazy podcast with myself, Kaz from Property by Kazy, and the man himself that we claimed last week has the best hair in property, Mr. Sam Norris. How you doing?
I'm good. I feel a bit under pressure now. The Barnet feels under pressure.
It's we'll take votes. We'll take votes in the comment section. You can gauge his hair out.
It's just bouffanty. So I've just got more of it than other people. It's not necessarily better. It's just more.
We like it. We like it over here anyway. I'm missing my long hair. I think I'm going to put some videos, some old throwback videos of me.
Get some little extensions in there.
Yeah, I could get some little bits done. Get my hair looking very wavy and luxurious. But today we're going to be talking about property, mortgages, finance, like how you actually finance a deal, different types of finance option for properties. We're going to keep it very sexy because often, mortgages are not the most fun, for want of a better word, things to talk about.
But mortgage, the word mortgage in Latin means till death. There's nothing sexy about death. So there's no way, and that's actually, that's one of the things that I found really, really tricky because as you know, like I'm a massive fan of like putting out content and giving away free advice and all that kind of stuff. It's hard. I was telling you about a video that I'm putting up on my YouTube channel about why you shouldn't use free legals with a mortgage. Like that's not cool. That's not sexy. It's good advice.
It's not clickbait, but to be honest with you, like the property space and the business space isn't sexy. Like it's, if you're selling somebody a get rich quick scheme, like how to make money, how to leave your job in 7 days from property, that sounds great. But the reality is that anybody that's been in property or around property or worked in associated services for a long time know that that's not the reality. So you're selling false dreams. So, I think for those people that, that stay the duration, stay the hour or however long this may be of this episode, it's because you actually want to further yourself and your own knowledge, your own expertise within a specific niche in property. And I think, it's not always, when you go to school, it's not always the lessons that you find the most fun are going to be the ones that benefit you the most. But understanding your finance and how to leverage and how to use finance to make your investments and make your money go further is one of, if not the most important lessons you could learn. So I definitely advise sticking around for some great advice by the man with the wavy hair. So I think just for people that maybe don't know you, explain to them what your role is, what you do, how long you've been doing it.
So for all intents and purposes, I'm a mortgage broker. I don't really like that term because it's quite pigeonholy. 90% of mortgage brokers in the UK focus on residential mortgages, which isn't really my forte. It's working more with investors and developers, as you know. But I've actually been in the game now. Now that we're in 2022, I can officially say I've been in the industry for 15 years, which means I went through the credit crunch. I've been through Brexit. I've now been through COVID. Seen lots of ups and downs in the market.
I think in custodial sense, that might class as a life sentence.
Yeah, pretty much. And it feels that way sometimes. I've worked for lots of different companies. As it turns out, I was a pretty crap employee. I put a video on my YouTube channel recently about all the different times I've been sacked from jobs.
Okay.
Because I'm not the kind of person that follows what everyone else is doing. So eventually I had to set up my own shop so that I could do things myself, which was Grand Union Finance, which I set up in just after the start of the first lockdown.
I keep forgetting when that was. It's 2020, right?
2020. So I think we officially opened doors in June 2020, although there was a couple of months beforehand where obviously there was some groundwork going in. It's not actually that easy to set up a finance company because the FCA and all that kind of stuff. And do you know what? I wanted to do that because, as I said, most mortgage brokers in the country focus on residential and they're bloody good at it, which is awesome. But there just seems to be a real lack of expert knowledge, not wanting to place any sort of labels on myself, but expert knowledge.
This is what we're here to sell greatness. That's what we're here for.
But actually understanding how property investors work. Finance is a tool to enable property investors to achieve what they want to achieve. Because you can go out and buy properties cash all day long, you can save you know, hundreds of grand over the course of a couple of decades, buy yourself a property and then do the same thing. You could do that, but it's going to take you a long time. Finance is just a facilitator to allow you to move on a bit quicker. And the different types of finance that you can arrange enables you to do it at different speeds. Mortgages are relatively slow, bridging development finance a little bit quicker. It's as simple as that. So I think what I really wanted to try and do with Grand Union was to establish a brokerage that could almost act a little bit like a mentorship service as well. A lot of people contact me just because they want to talk about their property strategies. Now, I've only done one flip myself, you know, I'm not in your league, but because I've got loads of clients that do, you know, you spoke to Jack last week. I work with Jack on the social housing side of things. I've got clients that have service accommodation, HMOs, larger development stuff, commercial to residential, all these different strategies I understand because I speak to these clients on a regular basis, and because I'm therefore then speaking to the lenders that offer the types of finance that they need, which is quite niche. And so as a result of that, you know, probably 3 or 4 sort of new client calls that I get a week are from people that just like, right, I'm starting out, I don't really know what I'm doing, I can't afford a, you know, 1997 course. Would you mind spending half an hour with me just explaining how this works and this works and this works? And yeah, look, I can't be doing that all the time.
Do you not find as well that a lot of those people are like, when you're saying you're explaining how a mortgage works or how a bridge or development finance works, sometimes people are embarrassed because, like, you know, especially sometimes when I speak to particularly like the Gen Z, the millennials, I think, oh, like they're part of this generation where you're supposed to know everything. But do you know, I speak to people that have, you know, come from 6-figure jobs that now want to start investing in property, that have been, you know, really high net worth individuals that still don't have a clue how a bridging loan works. Yeah. So I think that concept of not being afraid to ask what you don't understand to further your advancements with whatever you want to do in the future, I think is something that's a really good takeaway. Not just obviously for those with the money to do it and have come from somewhere and, you know, that they've been doing what they've been doing for a long time, but particularly for those that are starting out as well, that really understanding what you currently have, and maybe you're missing some of the pieces to the puzzle, whether that be your credit score, whether that be income, whether that be, you know, assets, whatever the case that may be. But understanding what you're missing is just as important as, you know, just having it in the first place. Yeah,
I did a talk recently at an event where I was actually talking about all the different sort of traits that I see in my most successful clients that sort of links them all together, and curiosity is one of them. Yeah. I didn't actually mention that on that talk. Maybe I should have.
Because this is the Property by Kazy podcast where you get the gems.
You get something extra that you don't get elsewhere, right? But curiosity is one of them. Not being afraid to ask questions. And I often actually say, and I don't know whether, again, I'm kind of like over-egging myself a bit, but if I talk to somebody who's brand new in the game on the phone for 40 minutes, I reckon 9 times out of 10, I will be able to tell you whether they're going to be successful or not, because I just get a sense of it, the kind of questions they're asking, the kind of stuff they're talking about.
We're going to find somebody in the comments that's, you know, just starting out in property. Ideally, we'd like somebody with a little bit of capital to get them going so we can find out sooner. We're going to find one of you drop us a message, say, look, this is me, I need to speak to somebody about potentially finance. You're going to speak to Sam. Sam's going to have a word in my ear and let me know. A year's time, we're going to see how you're doing.
Do you know, back in the day, so I for a couple of jobs that I did, I worked in estate agents. I was that broker at the back of the estate agency.
In-house, when they say, like, we're going to speak to her. They force you as well.
If you will not get your offer accepted unless you speak to our mortgage advisor. That's bullshit, by the way. They can't do that. They are literally not allowed to do that. In fact, when I bought my first property, they made me do my mortgage through their mortgage advisor. And I always remember I drove over to Brentwood Services to meet this guy on a Sunday morning, and he tried to like slip over this fee agreement. And I was like, mate, I'm going to be submitting all of this. This is the easiest money you're ever going to make in your life. You can put that fee agreement away. But I used to sit in the back of these estate agents, and what they used to do as like a little trick to try and get the people to speak to the broker would say, oh, we're just going to get them to validate the mortgage arrangements that you've already got through your other broker. So it was an opportunity for us basically to sit down with them and get an understanding of what their financial situation is. And basically it was kind of also, might be able to get some business out of it, but it was to report back to the agent to say, actually, yeah, they're in good nick, or you might not want to go ahead with this. And it kind of comes from there, because you really delve into someone's financial situation, you ask them probing questions, and you really do just get a sense of where they are. To be honest, I just think you sort of touching on it earlier. Financial literacy in the UK is crap.
Yeah.
In fact, it's poor across the whole world.
Yeah.
It's amazing that you leave school knowing what Pythagoras' theorem is, but not understanding how to open a bank account.
This is a good question, though.
It's ridiculous.
I've got a question for you.
Go on.
Because you said you knew what Pythagoras' theorem was when you left school. Sam Norris, can you tell us about Pythagoras' theorem?
I left school.
No, you claimed it.
I said when you leave school.
Oh, was it me or somebody else?
No, when you leave school. It's been a long time since I left school.
I don't know. He hasn't got a clue.
It's got something to do with the triangle. It's a triangle.
That's what everyone.
Okay, and it's one of the sides is equal to the sum of the other two sides.
I mean, yeah, it's a lot.
Or something to do with the angles.
You can work out the size.
Okay, let's put it a different way. You're taught that at school, but you're not taught how to set up a bank account, what an interest rate is, what the Bank of England does, some of this stuff, or even just how to set up your utilities bills. Stupid stuff like that. I know maybe that's going off topic a little bit, but you said earlier on that people don't understand what a bridging loan is. I'd go further than that. People come out of school not knowing what a mortgage is.
Yeah. Now we speak to people all the time that, for the sake of a £80 phone bill with EE, have ruined their credit for the next 5 years.
Yeah.
Not understanding the importance of credit scoring and what a CCJ is.
And do you know what? All that stuff is so simple. When I first met my wife, she wasn't brilliant with money, and she says, "How do you never miss a payment? How do you remember everything?" And I just said, "It's really freaking easy. When you get paid, goes into an account. Automatically, all your bill money goes into a different account that pays all your bills. Whatever's remaining, you spend." Yeah. It's so simple, but nope. It's like anything. I know you were talking to.
I think that idea of money management, because a lot of stuff may become specific, and I think money management and credit, those two things, and the importance that they play in growth. Because in terms of transitioning from you come from school and you maybe get a job and you get a better job to the point where you have disposable income, or you increase your expenses. That's really when that step between, now you've got disposable income, you've got an opportunity to invest. Well,
do you know what? I can't remember who said this. I'm gonna steal someone's phrase, but I remember reading somewhere. There's two problems when it comes to money.
I can see what the phrase is.
Not having enough or having too much.
Yeah.
And the problem is, and as I've sort of become more successful, I've suddenly now look at kind of like my company bank accounts and stuff like that, and there's money in there, and it's like I want to spend it. And actually that not spending, actually thinking longer term rather than just month to month, which everyone's brought up to think month to month. You get a paycheck every single month, or some people get it week by week, but on the whole, month by month. So, right, okay, I'm getting $2,000 coming in. I've got to spend $1,000 on bills. So I've got $1,000 left. I've got to spend that this month. You don't.
Yeah.
Of course you don't. And there was a Kevin Hart video that's been doing the rounds where he talks about, he probably earns a little bit more than me and you, but he says, if you get that amount of money coming in at the end of the month, straight away half of it, just put it away as if you've got to pay it for your tax bill. I know in America, obviously, they need to do their own taxes and all kind of stuff, but if you're self-employed, put half away. Whatever remains, split that in half and put half again into like a investment, savings, whatever. Whatever remains, that's your money. And you can use that until the next paycheck comes in.
I saw that, and obviously that's a very fortunate position to be in, where you don't need 75% of your money.
But you can manipulate that to your own personal situation.
But in saying that, also Americans they pay a lot higher taxes.
Yeah, of course.
And then higher incomes to higher taxes. But I definitely think the advice. Who was it with that we were speaking to? No, it was with Axel. Axel, the property comic, or Axel, the comedian, and he was speaking about the concept of saving first and spending second, so you can spend guilt-free.
Yeah.
So if you know that you, for example, have a savings goal which is realistic, because also there's no point setting an unrealistic saving goal.
Yeah.
If you earn £1,500 a month, there's no point saying I want to save £500 when you've got £1,000 worth of expenses.
But it's also okay to save 50. It's okay to save 50.
But whatever it is, save that first. So your investment money, or whatever it is you want to invest or save, save that first. So you've allocated that money to a separate bank account. There's loads of great accounts like with Monzo where you can really actually set yourself up saving goals and spending goals and different things like that. Save that money first. Then the money that you've got for your bills, set that aside. So then if you know that you have a disposable income of whether it's £100, £1,000, whatever the case may be, you can spend that money guilt-free. And if you choose not to, the following month you may have more to spend.
Exactly.
But it's just that's
or you've got
money,
more to put away.
Or you've got more to put away. But the thing is, it's like that, if you know particularly as well, for example, for a long time like that, you know, if you know that you're not good with saving, if you save as if it's spending, then you can spend, you know, you don't have to manage your money all the time because you've done it by proxy.
There was something similar to that I heard, which is the process of, say, I know you were talking about trainers earlier. You see this new pair of trainers that you want, 110 quid. You go, okay, I want to buy them. Well, what you do is you put that 110 quid away. If out of whatever you have remaining, you still have enough money that you could go out and then buy them, go out and buy them. If you don't. And then you've put that money away and it's now accumulating interest or it might be because you're saving for, you know, deposit for a property or whatever it might be. And yeah, do you know what? You might be a bit pissed off short term that you haven't got those trainers, but it's not like you're walking around barefoot, you know, you're probably going to be okay.
It's the concept of, you know, like, you know, delayed gratification. Like, you know, so maybe short term not being as comfortable for long term comfort.
People are poor at prioritizing their finances. And, you know, I've seen on other episodes that you've done where you spoke to people and they've talked about this, where people say they want to be successful as property investors, but they maybe don't then take the necessary steps to actually do it. One of those necessary steps for me, I get all the time, Sam, how do I save a deposit for a mortgage? Well, every month when you get paid, you put some money in a savings account. Simple. Oh, that will take too long. Okay, well, buy some stuff and sell it on eBay and double your money, and that'll increase it quicker.
Yeah,
that sounds like hard work. Well, of course it's hard work because property's not easy. Being successful isn't easy.
Money like that, you know, like, and I love an old saying, like, you know, money doesn't grow on trees. Like, you can get to the point where you can create money, and like you do things where you get to the point where like it's literally like printing money, but you have to do a lot of groundwork to get there.
Exactly.
Like, I remember speaking to somebody and they were like, their mailing list is like printing money, because now they got a mailing list. Every time they got a new product, they're literally going to be like, look, I can send it out to my most loyal clients, customers, and the chances are they're going to buy it. But that mailing list took them 5 years of hard work to build up.
Do you know, to use like maybe even I mean, that's relatively modern, but even more modern than that, one of my clients managed to save a deposit for a property through monetizing his YouTube channel. So the guy gets between 5 and 7 grand a month on just AdSense on YouTube. But that came as a result of posting video after video after video after video after video, learning how to edit better, doing all this kind of stuff. And that is a passive income. That's gonna, you still need to be putting new stuff up to keep it YouTube's interest, but that is just one way. That maybe took a year of hard graft, posting 2-3 videos a week.
Like, you see, obviously, like, it's like now, like, say you take some of the greatest YouTubers or the most successful YouTubers in the UK, like KSI is a really good example. Like, you know, and he started with a passion. He started like something, he just liked to play games. And if you go and check his videos now, every video's got millions of views. And even the oldest videos. So people in their head will be like, oh, but he was getting millions of views from day one. No, like, really and truly,
no one gets millions of views.
They were there grinding. Like, look, like even with a relatively big Instagram platform, my YouTube, like, you know, watching this video, you're probably watching this now and it's maybe got 300 or 400 views. And, you know, you've had to come down to film, I've had to take time out of my day. We're both in our own vocations, doing well within what we're doing. But it's the idea that if you want to build something, it takes groundwork and it takes time. And I think that attitude transcends into whatever you want to do. So, you know, saving for a deposit, unless you have a really well-paid job or, you know, have something that you're doing that's paying you really well, it's going to take time. But, you know, once there are strategies that you can put in place to speed that up. It doesn't mean that you're going to take buying a property from being, you know, a 3-year goal to a 2-week goal. But, you know, there are things by saving, by investing, by actually prioritizing, by doing like a review of your accounts. All of these things can help reduce time. And if you are able to buy a property in 2 years rather than 3 years, that's still an amazing feat that you've managed to speed up your ability to own, you know, that generational wealth asset by a year, by 30%. So I think sometimes, you know, that thing we touched on last episode with Jack about kind of looking at what are realistic, achievable goals and working towards putting steps in place that can allow you to achieve them.
Yeah, and do you know what? I mean, two things on that. I said two things and I started with A. Two things. One.
Two things. Square.
Yeah. Firstly, you've got, I always say to clients, your first deal is going to be your hardest. Not only are you know, just if we just segment what I'm talking to them about in their finances, it's the first time they might have taken a bridge loan or even a mortgage for some people. They're having to learn these things, but they've also got to learn how to speak to estate agents, how to negotiate with solicitors and talk to them, how to deal with their accountant, how to set up their company, all this kind of stuff, builders, you know, everything. I partly do that because it's true, but I partly do that to kind of really grill it into them that it isn't going to be easy so that their expectations are actually in check, so we'll probably get a better relationship as a result. But also I say to them, you know, because it starts out hard, it does get better and it gets easier. And actually, the growth of say your goal is to build a cash flowing property portfolio, your growth of that portfolio will be exponential. Because as long as you can create a system whereby you're not having to rely on the income that your portfolio is generating you, so you do have a side hustle or a business or a job, you can keep putting that money back into that property portfolio, and the rate in which you can buy properties goes like that. Yeah. It doesn't go like that. And that's
it's like an exponential curve because,
yeah,
you know, that concept of emptying the bucket. If you've got one property and you're waiting, you know, for generally speaking in the UK, prices go up. So as you continue, you can withdraw equity from the property, which is, for those that don't know, give them a quick withdrawal equity.
Yeah, it's basically, you know, every 2 to 5 years, which is generally when the fixed rates are on your mortgage come up. It's at that point that the 90% of my clients will look at refinancing, moving to a different lender. Sometimes actually we stick with the same lender. Sometimes you can still refinance or product transfer with the same lender, and you can base your new loan off of whatever the current open market value is. So if you bought it for 100 grand, then you've got a 75% loan to value mortgage, and then in 5 years time it's worth 120. You know, that difference you can draw out. And I often say to clients, look, generally speaking, there's 2 stages. Obviously, look, property investing is pretty complicated, but I try and simplify it as best I can for people. There's 2 stages for me in building a property portfolio. That's the growth stage and the consolidation stage. I've seen it time and time again. I've got clients that are on one path, I've got clients that are on the other side of it as well. And generally speaking, it's a point of you're growing and your cash flow is not that important, because you shouldn't be taking income from your property portfolio at that stage. You want to be constantly refinancing, releasing equity, reinvesting that money, the money that you are making on a monthly basis through your rental income. You keep it in the pot. It's there growing, build more, buy more properties. You get to the point where you have then achieved your goal of the net cash flow you want, or the number of properties that you're comfortable managing or looking after. And then you look at consolidating, you look at actually realizing your cash flow. It's at that point that maybe you can go, I can give up my job now, because what I'm going to start doing is, or maybe you might not give up your job straight away, because you might say, okay, for the next 5 years now, what I'm going to do is, instead of every time I refinance, I'm going to increase it back up to 75%. My goal actually now is to get it down to 60%. Because 60% loan to value mortgages, generally speaking, are the cheapest rates on the market. So you get it down to below 60%. And then you're getting the lowest interest, you're paying the lowest amount, but you're still getting the same rent that you were before.
And so your cash flow's gone up.
So your cash flow goes up, and it's at that point that you can go, right, let's turn on the taps and let's take some income. But you need to go through that growth stage first and foremost.
Sam, you know what you really need, yeah?
Go on.
You really need, we need a whiteboard for you today, with that explanation of, so you start with the property, and, you know, it's the concept. I think the person who explained it to me is you just wait for it to, properties are like waiting for it to rain. You know, it doesn't rain all the time, but when it does, you have a look in your bucket. Sometimes only a little bit of water in there. You say, okay, I'll leave that for later. You get to a point, sometimes you look in your bucket, you say, there's a lot of water in there, let me pour that out. If there's enough, you can use that to, you know, to get another property. And if we had that big whiteboard, you see that example of all these buckets filling up, and every time they fill up, when there's enough, you can use that to go and acquire another asset.
Yeah.
and you can grow a portfolio like that. And it's not the fastest way because, you know, my strategy is slightly different with the flips, and we're looking to actively, you know, add value to these properties. However, you know, it doesn't mean that it's not a really suitable strategy for a lot of people, particularly for those that want something that's slightly more passive than the flip strategy. Pause. Listen, the more you subscribe, the more you got those notifications on, the more you comment, the more exclusive content that we can make for you. So if you haven't already, subscribe to the channel. Costs you nothing. Back to the video. You know, that's all really interesting. I think there's a few more things that I wanted to just ask you your opinion of maybe changes that have happened recently. One was the change in, you know, the Bank of England base rate.
Yeah.
Kind of, how have you seen that affecting products, and where do you see like rates going sort of over the next 12 months?
Yeah, it was a tricky one. I mean, I'm quite happy to admit when I'm wrong, as well as tell everyone when I've been right as well. I actually said I thought they were going to increase it in November, but they didn't. And then I thought, well, they can't do it in December or January because, you know, that's harsh. It's a difficult time of year for people. And then they went and did it. So I think it was the right thing to do. Inflation is really high. We need to combat it some way. In the Western world, the best way of doing it, or the way that we've always done it, is to increase interest rates. It's not exactly a massive increase, and historically interest rates are still ridiculously low. I have seen a huge increase in the inquiries I personally get from existing clients and new clients wanting to refinance stuff, even when they haven't actually finished their fixed rate. Just going, here's now a time, even if I mitigate paying
the redemption
early repayment fees, is there, you know, will it still work out in the long run for me to
yeah,
sort of
literally I've had that exact. So not so much for it, the rates don't make me rush out and be like, I need to buy something new, but for existing portfolios, I did do sort of like an in-house analysis to say, look, where am I? Well, I didn't do it. I said, can you help me with my in-house, like with my analysis where I'm at? And a few of them were like, look, even though, you know, the values haven't changed, or exactly the same, you know, that you're gonna have to pay a redemption penalty, maybe like at the 1% or something like that, because rates are so low and potentially they're gonna go up. Now kind of makes sense to, if you want to have no plans to dispose of this asset in the near future, it made sense. And for a few of those, it was a case of, do you know what? Yeah, I had a redemption penalty of about $3,000.
It's like but I was going to think long term.
Yeah, I'm gonna repay that over the next 12 months. And some of them, like, some of them I'm like, you know, rates are really, really low, particularly the stuff in my, like the couple of properties I've got in my personal name.
The personal name stuff is dead cheap at the
moment.
It's
a joke, like, so, but then what it means is your typical sort of vanilla buy to let, that where you typically be hoping to make £200 or £300 a month, I'm making 800 or 900 on these because the rates are so low. So then in my head, I'm thinking, okay, in terms of just, these are products where, because they're in my personal name, I don't have double taxation. I can actually take the income because I might as well, because only an element of the interest anyway is tax deductible. So they're really good if you're saying, okay, I want to bolster a salary. So some of those, like, you know, obviously everybody's tax position is different. I'd always advise you to, you know, speak to your accountant and financial advisor regarding what works for you. But it's a really good opportunity at the moment to actually use those sort of buy-to-lets to maximize an income.
Yeah, and do you know what? I was talking to somebody this morning about this. They were saying, you know, what's going on with the market? And I said, I don't think the market knows what's going on with the market at the moment. The rate increase has only been pretty minor. The Bank of England have pretty much almost come out and said that at some point during the course of this year, there's going to be more rate increases because inflation's actually pretty high, you know, compared to where they want it to. And that's actually not wanting to go into economics, but the real rate of inflation is probably even higher than that. The rate that they put out to the public is a manipulated rate because they choose how they measure it, basically. So they can change certain things to manipulate it. But even with all of those things they've got in their power to do that, it's still high, it's still above what their target is. So as I said, best way of doing that is increasing rates. But they also, this is what the public and the media in particular get very scared about, is, oh my God, rates are going to go through the roof. No, they're not.
Because in terms of comparatively to where they've been.
Yeah, you can't have like have a scale with loads of weights on one side and then just go, oh no, we're just going to move them all over to the other side. It doesn't work like that. So they're going to have to do it gradually.
Where do you see rates sort of maybe
I wouldn't be surprised if it was above 1% by the end of this year. I wouldn't be surprised.
I might just be a pessimist, but that's why I was like, they're going to be above 2%.
But you know what? This is what makes me laugh. Okay, so on the way over here, I was talking to a commercial lender who have just reduced all of their rates across their entire product range.
Yeah, that literally, I was like, I've just sent an application with them.
Yeah. So it means that some lenders are putting them up, some lenders are putting them down. What I don't see is a mass market move with the Bank of England.
Yeah.
So what that says to me is that the margin for their profits is still good enough that they're working just off targets and stuff like that. They're not being manipulated by the Bank of England, which is actually pretty good for investors, because it means that they don't have to necessarily rush out and start remortgaging everything. I think rates, some lenders, as I said, are still reducing rates. Will that continue for the next quarter? Who knows? I think another rate increase by the Bank of England, maybe Q2, is probably on the cards, and that might be enough to start pushing lenders to en masse start just increasing rates. But they're not going to be increasing them by much.
And relatively to where a lot of people, like if we use the example of your average fixed product is, maybe 2 years, but when they did the recalculations for affordability when it came to buy-to-lets, a lot of them had to stretch to the 5-year product.
Exactly.
If you're on a 5-year product and looking at rates 5 years ago, you're still going to get a comparative, remortgage. So I don't think it's that time to be like, okay, we got to put fires out.
It's a case of, look, when stuff like this happens, I mean, look, I was about to say this is the time to review things. If you're an investor and you've got a portfolio, you should be reviewing it pretty regularly. Yeah. That's your job. But now is a good time to review things. New year, slightly different circumstances. Check what's going on with your rates, but don't get stressed out about it. Don't panic and think I've got to do this now because in a year's time when my rate comes up, it's going to be like 3% more. It's not. Like I think if you use HMOs,
you're going to take that as a crazy soundbite if it is.
Yeah.
Like, it's not. It's not good.
And then it's like, 10 months later. Sorry, I was wrong. Which I'll hold my hands up and if I am, I am. But you take HMOs for example. When I first started doing HMO mortgages, when I got into the specialist part, probably 7, 8, 9 years ago, you were easily paying 4% plus, sometimes even 5% for an HMO mortgage. Now you can get 5-year fixed rates on an HMO for 3.5%. Like that's insane, and that's not. This year is not the year where that's going to go back to 4%. It's not. It's gonna. You're still going to be able to get those HMO mortgages, and I'm just using HMOs as an example. Those HMO limited company mortgages that start with a 3. In fact, there are some lenders out there that they even start with a 2. Believe it or not.
Like the 2 point, like they're very close, like 2.98.
Yeah.
That's how you know we're talking about the same company.
So, and so that isn't going to change massively. So I don't think people should be panicking. But in reality, we've had a really good run of stupidly low rates. Yeah. You go back a couple of decades and people paying 15% interest. Yeah, Can you imagine paying 15% interest on a mortgage?
Yeah, but that was also the time when people were just going to banks and posting their keys through the letterbox and just saying, just take it back.
Yeah, exactly. Or this was the other thing. So when I started working for quite a big brokerage in London in 2011, I think it was, something like that. Big real estate company in London, and a lot of the brokers that were working there were still like old school. So they were I was lucky. I got qualified in 2008. As it turns out, not the best time to get into finance. But I started training in 2007, got my qualification in 2008. So I never knew the good old times or the good old days of, you'd be able to get a 1-page mortgage application, sign it Mickey Mouse and send it off to whoever, and you'd get the money in a couple of days. But so many of those brokers were still in that mindset. So I've always grown up with it's hard to get a mortgage. So now when things have actually relaxed a bit from a regulatory point of view, I'm still working off the mindset of, no, we need to be making sure we're crossing every T and dotting every single I. And it's, I think as a result of that, I've seen quite a lot of success with my clients because as a result, things are quite speedy because we cover all bases. But it was actually so funny, like hearing some of these stories from some of these advisors, and they'd say we'd get in the morning at 9, we'd do 5 or 6 applications that would make us, 3-4 grand a pop, and then we go to the pub all afternoon and drink vodka. It's like I can't even imagine. Even now, when I've got like some of my friends that work in the industry, they're like, "Oh, Sam, do you want to come and meet us for dinner tonight?" And I'm like, "Yeah. What time?" They're like, 5:30. I'm like, 5:30? What time? What time do you finish work? You know, it's crazy. But you know, this is our market. Mortgages are hard. You know, the regulation is stiff, and we get a lot of kickback from clients going, oh, why do lenders want to know this? Why do they do it? Lenders know more than everyone else does. They're banks. They're big financial institutions. They understand this market better than anyone, and they're doing this stuff to protect borrowers. At the end of the day, that's why they do what they do, and that's why I'd much rather have our market, which takes X amount of time to get a transaction through, rather than say the US market, where you get a mortgage like that, or you can have 20 mortgages if you want.
But the repossession rates are way higher.
Exactly. I'd much rather it be this way around. People are protected, and we have, in my opinion, we've got the best lending market in the world, and we should be pretty proud of that. But there are some bad parts of it, which means things maybe take a little bit longer. But you know, that comes back to this delayed gratification thing that we keep circling back to.
So a few other recent changes away from the rates. Recently, I saw there was, you know, because typically, you know, it was maximum 5 times, average about 4.5 times your earnings on a residential mortgage that you could borrow. So, you know, for layman's, that means effectively if you're earning £50,000, you know, a bank would potentially lend you up to £250,000 to buy your property, and then you would have to put in your deposit, depending on which mortgage it is, anywhere for sort of 5 to 15% as a sort of standard in current conditions. But recently, I saw that there was a you know, something that you could get where it was 7 times your earnings potentially you could borrow, and it was a 7-year mortgage for 7 times or something like that. What do you think of that product?
First and foremost, we don't work to an income multiple process anymore. That went out the window 2015, 16. Ironically, with regulation that was brought in from Europe. So we work off an affordability thing now. So yeah, okay, the base level is I earn X, therefore if you times that by 4, 5, 6, 7, I could potentially earn that. But in reality, if you earn that amount versus somebody else that has, you know, the same amount in liabilities, then you're not going to get the same loan amount. It's about affordability. It's about surplus income and whether that is enough to cover the mortgage payments and then some. That's how it works. So the whole 7 for 7 is a bit of a gimmick, I think. But also, you know, it's very, very specific to a very niche type of professional, you know, doctors, dentists, these kinds of people that have access to those products. So it's not going to make a big difference to the market.
Okay, so it's not that change to the market where they're saying, because, you know, we've seen a lot of people.
The mortgage market doesn't change.
Because we've seen a lot of changes. Like you see changes that say when we speak about, because although you say it's linked to, you know, circumstance and affordability, you also see people that have paid £2,000 in rent for the last 8 years, but then can't borrow on a mortgage that's £1,300.
This for me is a where it could be a bit of a game changer in our market. The problem you have with the mortgage market is you've got so many big players. You've got your Barclays, your Santanders, your NatWests, you know, your Halifaxes of the world, and they've all got to agree to do this kind of stuff. And ultimately, it's the FCA above them. You know, for anything residential, they regulate it. They've got to make the decision for this. And so, in my humble opinion, if you've been spending £2,000 a month on rent for the last 5 years, then why the hell, you know, and you can prove that you've made those payments.
You can prove it. And that's why I think some of these companies that are coming out saying potentially linking like rent to credit scoring and other stuff like that.
I agree with that 100%. Linking that's your biggest payment, you know.
So why is
that not on there?
Important?
Exactly. And this is, you know, like I talk about credit files a lot. There is so much, you know, I could do a whole hour's podcast talking about credit scores and credit reports. Probably be really boring, but it's kind of broken. That whole system is broken, but it's one of those things where it's so ingrained and it's so institutionalized that it's difficult to change. And that's where the mortgage market, in my opinion, suffers, because we have you know, property investors are some of the most creative people in the world. They come up with these ideas, and I get it all the time, and I have to be the bad guy, because I have to say to them, that's a really good idea. That could help a lot of people, and it could help you, and I can certainly see how you could be successful on the back of it. However, I've got to be the villain here and tell you it's going to be really freaking hard to find lending for it.
It's going to class as non-compliant based on the current constructs of the lenders and how their terms and conditions.
It takes time, you know. I was talking to somebody about service accommodation recently, and the mortgage market for service accommodation is the Wild West. They can't even decide what they want to call it. Some lenders call it holiday let, some lenders call it service accommodation, some lenders call it short let, and there's no general criteria across the board for it. It's where some of the other things like HMO were maybe 6 or 7 years ago. So it will probably come around, but it frustrates me that we are in that kind of staycation boom that we've been talking about, you know, people staying in the UK, utilising Airbnb, Booking.com, all this kind of stuff. And there just isn't that lending to support that market, which is kind of frustrating, but it will get there, because where lenders start seeing a demand, all it takes is one decent sized lender to make that jump.
To service the demand, and then people are like, hang on, we don't want to lose out on our share of this business.
They want to see a proof of concept, and if lenders don't see that, then they don't want to be the ones to stick their neck out.
Take the risk, yeah, because like naturally it's risk and rewards, and you know, looking at, well, like I haven't seen it work.
Well, this is it. I say to clients all the time, they're like, why won't this lender lend to me? I said, because they don't want to, and they don't have to.
Yeah.
They make a decision. They've got some really sophisticated ways of figuring out whether lending you this money on that project is a good enough risk for them. And if it isn't, they won't lend it to you, and they won't lose any sleep over it either.
Yeah, like I've had, like, you know, particularly, and actually we're going to ask you some quick fire questions at the end of this of, you know, common sort of lending myths. But I was declined an application with my own bank for a buy-to-let for a property. I think the purchase price, and bearing in mind I live in London, it was like £130,000. It was below market value. It like met, you know, sort of doubled the income criteria, and I can't remember what it was. It was something to do with an element of my income, too much of it being from property.
Yeah.
And it was like, but have you not, you know, in my head I want to say, do you not know, like, the equity that's here and the other lending that I've got and X, Y, or Z, and like, but you know, like I'm speaking to the person, that you know, the mortgage advisor at the time, and I know it's not her fault, but I'm getting frustrated because I'm like, you've got me here and you said like it's failed X on something. And I was like, why am I here? Like, I could have, you knew that I didn't have that, you know, before we even got it, but you get it, there are a lot of like that computer said no element.
That's a really frustrating thing about the kind of the banking side of this industry, is that it actually, this really annoys me, and this isn't a myth, this is the truth. Most of those in-house advisors have a decision in principle application target. So if they say, make it up, let's say they have to do 100 a week. If they hit 100 a week, it doesn't matter whether they pass or fail.
Whether they pass,
ticks a box, they get a bonus.
So it's the idea of.
So whereas for me, if someone comes to me and says, "Here's my circumstances," and I get it all the time, clients come to me, "Oh, do you know if so and so will lend to me?" I'm like, "Well, let me do my job, and I'll let you know who's going to be the best lender." But I'm not going to submit an application or a decision in principle to a lender that I'm
just for the sake of it.
It's a waste of my time, and it's a waste of their time.
And it's like the whole thing of like when you look at like the police, and police are given like KPIs that they've got to do. You've got to give this many speeding tickets out, and it's like, so then now because you've given somebody a target that you've got to achieve that deemed as whether or not they're successful, that's what you've done, and you're successful in the eyes of you've done what your boss said, but then the crime hasn't been reduced, or you haven't actually helped at all, but we've given out this many speeding tickets. Exactly,
and it's that's where, again, it's like circling back to what we were saying before. When we're talking about lending and what they want to do and who they want to lend to and why, these lenders have got like tick box operation, and that is effectively what I kind of do in a roundabout way. I mean, I'm teaching some of my other team members at the moment to kind of be brokers and do this kind of stuff, and it's funny because I'm having to like really think about it. It's a bit like riding a bike. You don't really think about riding a bike or driving a car. You don't think about driving a car until somebody actually says, how are you doing that? And I'm going, oh yeah, hang on. So yeah, you need to make sure you ask them this, this, and this. But then I don't even realise it sometimes. I'm talking to a client and I'm just reeling off the criteria list in my head.
In that with somebody over here that you're just having a conversation.
Because I know what box to put them in.
Yeah.
You know, like for example, like with buy-to-let mortgages, first and foremost, I'm like, okay, how much is the property worth? What's the rental? So straight.
That's the first thing that if it doesn't.
Yeah, straight away I just do basic, rental calculator in my head sometimes. Is it going to work? Yes. Sometimes I can just look at those two figures and I'm pretty certain I know which way it's going to go without even doing it, because I've done it so many times. Then it's, right, what do you earn? Okay, I earn this amount. Okay, well, I then know that we need to go for a lender that doesn't have a minimum income requirement because they only officially earn $6,000 a year or something. So if I go to a lender that's got a 30 grand minimum income requirement, can't go to them. Are you a homeowner? Yes, I am. Excellent. Ticking the box. No, I'm not. Okay, first time buyer, first time landlord.
So all of those things and all those little boxes, and you're finding where
it's like one of those diagrams, when you like hit something and it's like you ask a question, it's like yes here, no here, and then it's a new line of questioning. Yes, and you go down. That's what I do in my head with every time. But this is how buy-to-let lending on the most basic of scales works.
Yeah.
It's just a tick box operation. If you tick all those boxes, you've got access to the market. With every single one of those boxes that isn't ticked, you have a smaller and smaller pool of lenders to choose from. Basically, it's as simple as that.
So that's good
so anyone can be a broker, it's easy.
For those that want to understand how and why they've potentially been declined or been pushed to another lender. Yeah. So we haven't got that much time left. I'm going to ask you a couple of questions, maybe like myths around the mortgage section or maybe just common misconceptions. And we just want very quick sort of yes or no, maybe a little bit of detail in them that I often get asked. So hopefully you can help some people. So first time buyer.
Yeah.
I've been told by my mum, my bank that I bank with are always the best person to go to for my mortgage.
Do you know what? Speak to them. Speak to them. Go and speak to your existing lender, so your existing bank. They know your circumstances. See what they've got to offer. Don't allow them to do a decision in principle until you've then gone and done a check with a broker yourself. When you're speaking to a broker, just make sure that they have access to the whole market. We can't call it whole of market anymore. The FCA don't like it. Unrestricted access to the market, and just get them to do an assessment for you. But your existing bank is not necessarily the best or the worst. You don't know where it fits. Just go and get some impartial advice.
Okay, so a bit on the fence, but we like that. Okay,
trying to be nice.
Yeah. Okay, so next one that I often get asked. I want to buy a buy-to-let for my first property. I don't currently own a residential property. I've been told I can't do that. Is that true or false?
You can. I'm currently doing one for a client. So there's a couple of things on that, which I'll try and keep as short and sweet as I possibly can. So one, back sort of credit crunch days, pre-credit crunch days, it was easy to get residential. Credit crunch happens, it was hard to get a residential mortgage. So what people used to start doing was, I'm buying this as a buy-to-let, but they're not, they're going to move into it. And it's because, as I've said to you previously, buy-to-let mortgage is based on what the property earns, not what you earn. So it was quite an easy way of getting what we call a backdoor residential. Lenders clamped down on that, and they didn't want it now because they were concerned that if you were buying a property and it's your first and it's a buy-to-let, you were going to move into it, and that would basically screw up the regulation. So sometimes they will actually do an affordability assessment on you to see whether you could afford on a standard residential mortgage that same mortgage. So it kind of mitigates the risk a little bit, and then also look at where the property is. If you live and work in London and you're buying this property in Leeds, chances are you're not going to move into it. So there are a couple of lenders that will look at that. It's a very, very small market. It really is a really small market, it's a bit frustrating because why should you not be able to invest in a property before you have a home?
But I guess sometimes, previous generations have maybe ruined something for those going forward.
Yeah, but it is possible.
Okay, so it's possible. Another one sort of tied into that question, but again, you can sort of answer it in separation. I'm either older, so 60 plus, don't have that long left working, or I'm not working but have the capital to buy an investment property. Am I still able to buy one without income or without long-term income?
There are a small group of lenders that will lend with no income. The problem, where people get a misconception is when they see, we talked about earlier, minimum income requirement. So some lenders might say, right, 25k, if you don't hit 25k, you're not getting a mortgage, end of. But then there are some lenders that don't have a minimum income requirement. This shouldn't be confused with no income requirement. They just don't have a minimum. So as long as the property income stacks up with their stress test and what income you do have, they feel comfortable with that being enough to cover any void periods that you might have during the year, they will lend to you. It will be within inside their criteria. But there are very few lenders out there that will lend to you if you have no income at all. But, and as you kind of mentioned earlier on in terms of property income does count. Some lenders don't like it. If you're a portfolio landlord, own 4 or more properties, more lenders are going to be inclined to accept your property income as your main source of income. So that can be included. So if you are refinancing and you've left your job, but you've got 2 years worth of personal tax returns that show property income on it, happy days.
Okay, so final question is in regards to credit. Question is, but the individual has a CCJ within the last 5 years. I've been told I can't get a mortgage.
You can. So the 2 significant things we need to be thinking about there is when was it registered and when was it repaid. So I spoke to somebody, funny enough, this morning who said, oh, I found out recently I had this outstanding CCJ, but it's okay because it was registered like 4 years ago. I said, but when was it repaid? He says, I haven't repaid it yet. I said, well, get off the phone to me and get on the phone to the people and repay it. However much it is, every single day that CCJ is sitting unpaid on your credit file, it's causing damage. Most lenders will start the time for how far away the CCJ
how historic it is from the repayment
when you repaid it, not from when you actually got it. So that's a sort of a misconception. You can get mortgages when you have a CCJ sitting on your record. You're just going to be limited. It's like that tick box thing we were talking about earlier on. If you can't tick the box of clean credit, that's going to wipe out a few lenders from your options. Doesn't mean you can't do what you can do. And this is not wanting to sort of widen this too much, but this is something that I see a lot of people getting upset about is, John down the road got a mortgage for X, why can't I have that? Because their circumstances are different. Don't concentrate on John, concentrate on you. What can you have? What are you trying to do? What are you trying to aspire to achieve? And what kind of finance is available to you to do that? And what products can you utilise that John isn't utilising because he's getting a residential mortgage and you're talking to me about HMOs? Focus on that. Focus on what you can achieve. A decent broker will tell you the best that you can achieve. You might go on to comparethemeerkat.com and it shows you that there's a rate out there at 1.2%, and I'm telling you the best you can get is 2.4. It's because the best you can get is 2.4.
It's all personal,
not a search engine. Yeah.
So, but before we let you go, we always ask all of our guests the same question, which is the most common question I get asked, which is, I'm 17, 18, 19, whatever age, but young, wanting to start and wanting to get into property. What steps can I take now to help to propel my property journey in the future?
Do you know what? This is genuine. If I was 17 right now and I wanted to get into property, I would go onto Instagram, YouTube, whatever, find a handful of really good quality property investors that I wanted to emulate, like Kazy, and I would contact them and say, right, school holidays are coming up, I'll work for you for free for 6 weeks. And just learn from these people. People think, oh, because I'm not getting paid for that job. You're getting paid in knowledge.
Yeah.
So go and learn your trade. As a 16, 17, 18, 19-year-old, you've got so much time to be successful. Like, people think, oh, if I'm not successful by 25, then I'm done. No, I'm 37, for God's sake. Like, I've only just started my company 2 years ago. And I still think that I'm at the start of my journey. So if you're 16 right now, go and learn from the best. That is exactly what I would do. And just reach out to these people. You're going to gain knowledge, you're going to gain contacts, and you are going to be, when you get to the point where you maybe have a point where you can have some money yourself to start investing, you're going to know how to do it and you're going to make less mistakes. Yeah,
because you would have learned and made those mistakes or seen those mistakes on somebody else's dam.
Exactly.
I think that's all really good advice, and especially the fact that there's nobody's success trajectory has to start at the same age. Like, somebody else might make it at 18, somebody else might make it at 28, 38, 48. Like, you don't have to look at what your peers or other people are doing. Your journey is yours and yours alone.
Yeah. If someone wants to come and work for me for free, they're more than happy to do so.
There you go, you see, and just because, where can people find you?
So I try and keep this as simple as possible. I'm the Sam Norris on pretty much every platform, Instagram, TikTok, Facebook, LinkedIn, YouTube. If you just type in my name, Sam Norris, I do this fairly frequently. I do come up top of the search. And I've also got a podcast, Game of Loans podcast, which you've been on. Season 2 coming soon. So if you search that on all major platforms, you'll be able to check that out as well. Good
stuff. Yeah, no, the link to Sam's page, the link to the episode that I've done on Game of Loans, and also all the socials and all the contact details will be below.